Have you noticed something strange lately? About 1 to 2 years ago, it felt like you couldn't escape Bitcoin. Every finance YouTube channel was talking about it. Every major news network had a new price target. Your coworkers suddenly became crypto experts overnight. Your Uber driver had an opinion on Ethereum, and social media was filled with people explaining why Bitcoin was going to 200,000 or straight to zero. Love it or hate it, Bitcoin dominated the conversation. Now, today, it feels completely different. Now, everyone's talking about artificial intelligence. It's NVIDIA, it's OpenAI, it's robotics, semiconductor companies, the next AI startup, the next $1 trillion opportunity. It's almost like Bitcoin quietly disappeared. But here's the interesting part: Bitcoin hasn't disappeared. Instead, our attention did. And I think that might be the biggest challenge Bitcoin has faced in years. Not another exchange collapsing, not another government trying to regulate crypto, not another price crash, and there's no shortage of downward price action lately, but something much more dangerous: irrelevance. Because markets don't just move on fundamentals, they move on stories. Every major investment cycle has had one story that captures everyone's imagination. In the late 1990s, it was the internet. In the mid 2000s, it was housing. Then it became electric vehicles, then clean energy, then crypto, and now today, it's artificial intelligence, which raises a really interesting question. Has Bitcoin actually lost its story? Or are we watching the exact same cycle we've seen over and over again throughout market history? Welcome back to Lunch Money Investing. If you're new here, my goal isn't to convince you to buy Bitcoin, and I'm definitely not here to tell you it's going to zero. Instead, I like following one thing: money. Because money usually tells the truth. Headlines don't, social media definitely doesn't. And price usually only tells you what already happened. Now, capital tells you what's happening next. And lately, capital has been sending a really interesting message. For years, Bitcoin wasn't just another investment, it represented something much bigger. For some people, it was financial freedom. For others, it was protection against inflation. Some viewed it as digital gold. Others believed it would eventually replace traditional money altogether. Whether you believed in any of those arguments or not, millions of investors did. And that's important because belief is one of the most powerful forces in financial markets. Entire bull markets have been built on beliefs. Our entire monetary system is built on belief. But beliefs can change, not overnight, but slowly and quietly, almost without anyone noticing. Think back just a couple of years ago. The biggest financial stories in the world were all connected to Bitcoin. Spot Bitcoin ETFs were all the rage. Institutional adoption, the Bitcoin halving, strategic Bitcoin reserve, Michael Saylor buying thousands of additional coins. Every week seemed to bring another headline, suggesting Bitcoin had finally entered the mainstream. Then something changed. The conversation moved elsewhere. Instead of asking whether Bitcoin could double, investors started asking which AI or tech company could become the next NVIDIA. Instead of discussing crypto wallets, people started discussing data centers. Instead of blockchain, everyone wanted to talk about large language models. The story changed, and when the story changes, attention and money usually follows. Now, that doesn't necessarily mean Bitcoin suddenly became a bad investment. Far from it. But every dollar flowing into one investment theme is a dollar that's not flowing somewhere else. Investment capital isn't unlimited. It rotates, and right now it's rotating towards artificial intelligence and away from everything else. Just look at the last few months of the SOX ETF that tracks semiconductor companies and compare that against Bitcoin. In mid-April and May of this year, they crashed in opposite directions. Governments are investing hundreds of billions of dollars into AI infrastructure. The largest technology companies in the world are dramatically increasing capital, spending $800 billion this year alone and up to $1.1 trillion for 2027. Venture capital firms are pouring money into AI startups. Even countries are racing to become leaders in artificial intelligence. That's where the excitement is, and excitement attracts capital. Now, here's where I think a lot of people get this story wrong. They look at Bitcoin's recent performance and conclude that Bitcoin itself must be broken. I don't think that's what's happening at all. I think Bitcoin is facing something much more subtle. It's competing for attention, and attention has become one of the most valuable assets in financial markets because attention eventually becomes investment dollars, which eventually becomes price. There's usually a huge difference between an investment that people hate and an investment that people simply stop talking about. History tells us that some of the greatest buying opportunities don't happen when everyone is bearish. They happen when people stop caring altogether. When headlines disappear, when Google searches fall, when television networks stop covering the story, when your friends stop asking if they should buy it. That's not panic, that's indifference. And honestly, I think that's much closer to where Bitcoin is today. Not dead, not broken, just forgotten, at least for now. But here's where the story takes a really unexpected turn. Because while investors have slowly been losing interest in Bitcoin, governments have quietly been doing the exact opposite. They're building new legal frameworks, modernizing financial regulation, creating infrastructure that could permanently integrate digital assets into the traditional financial system. So, if all of that is happening behind the scenes, why isn't Bitcoin soaring? I think the answer has almost nothing to do with Bitcoin itself. And that's where this story gets really interesting. Now, if you've watched this channel for a while, you've probably heard me say this before. Markets don't always reward the best investment. Instead, they reward the investment with the best story. And right now, Bitcoin has a storytelling problem. Before all the Bitcoin bulls click off the video, hear me out. I'm not saying Bitcoin has become a worse asset. Instead, I'm saying another investment has become a better story. That's it. Think about where we are today. Artificial intelligence is changing almost every industry you can think of and potentially upending the entire economy. It goes beyond companies building massive data centers. Governments across the world are competing to be leaders in AI, modernizing infrastructure to support these data centers and the factories that supply them. Utilities are expanding power grids just to keep up with electricity demand. Entire nuclear power plants are being brought back to life. Every earnings call seems to mention AI. Every venture capital firm wants exposure to AI. Every CEO suddenly has an AI strategy. Whether it's justified or not, that's where investors believe the future is being built. And that's important because money follows belief. Now compare that to Bitcoin. What's the big exciting headline today? There really isn't one. The Bitcoin ETF was approved. The halving already happened. Institutional adoption isn't a theory anymore. It's reality. And that's actually part of the problem. The biggest catalyst everyone was waiting for already happened. Markets are always looking forward, not backwards. Once a story becomes reality, investors immediately start looking for the next big thing, the next story. That's exactly what happened here. But here's where things get interesting. Even though Bitcoin has faded from the headlines, the foundation underneath it has never been stronger. Most people don't realize this because it doesn't generate flashy headlines. Instead, it's happening quietly in the background. Over the last year, the US government has taken several steps that would have sounded impossible just a few years ago. The Trump administration established a strategic Bitcoin reserve using Bitcoin that has already been seized through criminal and civil forfeiture proceedings. Instead of auctioning it off like previous administrations, the government is now treating Bitcoin as a long-term reserve asset. That's a massive shift in thinking. It also created a separate digital asset stockpile for other confiscated cryptocurrencies instead of simply liquidating them. Again, another signal that digital assets are increasingly becoming viewed as something worth holding on to, not immediately selling. The administration has also pushed to permanently restrict the development of a US central bank digital currency, arguing that a government controlled digital dollar could threaten financial privacy and individual freedoms. Whether you agree with that position or not, it's another example of policymakers acknowledging that digital assets are becoming part of the financial conversation. And perhaps the biggest development that almost nobody's talking about is what's happened inside the banking system itself. Early this year, the administration signed an executive order directing regulators to better integrate digital asset companies into the existing financial system. Now, I know that sounds incredibly boring, but stick with me here for a second, because this could end up being one of the most important developments for cryptocurrency over the next decade. Historically, crypto companies have operated outside the realms of traditional banking. That created friction. Payments were slower, moving money was harder. Banking relationships were limited. Now regulators are working towards giving qualified crypto firms direct access to payment infrastructure like FedNow and FedWire. That doesn't mean crypto companies suddenly become banks. They don't. But it does mean moving money between traditional finance and digital assets could become dramatically easier for individuals and companies. Think about it like this. Imagine trying to build Amazon in the 1990s before reliable internet existed. You could probably do it, but everything would be a lot harder. Infrastructure matters. It's not exciting, it doesn't generate headlines, but it's what allows everything else to grow. And I think that's exactly what's happening with crypto today. While everyone is focused on price, the infrastructure continues improving underneath the surface, which brings us back to the question we asked earlier. If the foundation is getting stronger, why isn't Bitcoin going up? Because fundamentals alone don't drive markets. Liquidity does. When money is abundant, investors become willing to take more risk. When liquidity tightens, they become much more selective. And right now, a smaller pool of capital is chasing whatever investors believe has the highest future return. Today, that's AI. 5 years ago, it was crypto. 15 years ago, it was social media. 25 years ago, it was the internet. The names change, the patterns don't. Now, there's one company that illustrates this shift better than anybody else: Strategy, formerly known as MicroStrategy. For years, their strategy was incredibly simple: raise money, buy Bitcoin, repeat. Michael Saylor became the single biggest corporate advocate for Bitcoin in history. At one point, it almost felt like Strategy had become Bitcoin's unofficial central bank. Every time they raised capital, they bought more Bitcoin, and investors absolutely loved it, as long as Bitcoin kept going up. But markets change. Bitcoin stopped making new highs, Strategy stock came under pressure, its preferred shares fell sharply, and suddenly the company needed something it really hadn't focused on before: flexibility. Recently, Strategy announced an entirely new financial framework. Instead of having one button, buy Bitcoin, it now has several: build larger cash reserves, repurchase shares when appropriate, adjust preferred dividends, and, if necessary, sell Bitcoin. Now, I want to be very, very clear here. That doesn't mean Michael Saylor has suddenly become bearish on Bitcoin. Far from it. In fact, Strategy still owns an enormous amount of Bitcoin and remains deeply committed to the asset class. But I do think this tells us something important. Even Bitcoin's biggest believers recognize that today's markets require a different playbook than the one that worked during the last bull market. And if the biggest Bitcoin buyer in the world is adapting, maybe investors should too. Because the question isn't whether Bitcoin is dead. The real question is whether the conditions that fueled the last bull market still exist. And before we answer that, there's one more risk we have to talk about. It's a risk that sounds like science fiction today, but could become very real in the future, and that's quantum computing. If you've spent any time on social media recently, you've probably seen headlines claiming that quantum computers could eventually crack Bitcoin's encryption and send the price to zero. At first glance, that sounds absolutely horrifying. After all, Bitcoin relies on cryptography to secure wallets and validate transactions. If that cryptography could be broken, wouldn't the entire network be compromised? Well, not exactly. The reality is a little bit more nuanced, and unfortunately, it's a little bit technical, but I'll do my best to stay high level. Today's Bitcoin wallets rely on something called elliptic curve cryptography to generate public and private keys. The function, for those of you who want to know, is fairly simple: y squared is equal to x cubed plus 7. Your private key acts as a master password, allowing you to spend or transfer funds. Your public key acts as a shareable bank account number, derived mathematically from the private key. This allows you to share this key and safely receive Bitcoin. In theory, a sufficiently powerful quantum computer could eventually reverse the process and expose private keys for certain older wallet addresses. The computer would simply have to solve for X. That's a legitimate concern, but it's important to separate a theoretical risk from an immediate one. First, experts generally agree that we're still years, if not decades, away from having quantum computers powerful enough to perform that kind of attack at scale, given the immense amount of compute and energy required. Second, Bitcoin isn't frozen in time. It's open source software. Just like the internet has evolved over time, just like smartphones receive software updates, Bitcoin can and will evolve too. Developers are already researching quantum resistant cryptography, and if the technology ever becomes a real threat, the network has the ability to upgrade over time. Could quantum computing eventually force Bitcoin to adapt? Absolutely. Does it mean Bitcoin suddenly goes to zero? I think that's highly unlikely. And honestly, I think focusing on quantum computing today is a little like worrying about asteroid insurance while your house is on fire. Sure, it's a real risk, just probably not the one investors should be losing sleep over today. Because in my opinion, the biggest challenge facing Bitcoin isn't technology, it isn't regulation, and it isn't quantum computing. It's attention. Remember what we talked about at the very beginning of this video. Bitcoin did not disappear. Our attention did. And our attention drives narratives. Narratives drives capital, and capital moves markets. Right now, the dominant story is artificial intelligence. That's where investors believe the next decade of growth is going to come from. Whether they're right or wrong almost doesn't matter because belief itself influences where money flows. But here's something history has taught us over and over again. No investment story stays on top forever. In the late 1990s, investors believed the internet would change the world. They were right, but that didn't stop the dot-com bubble from bursting. In the mid-2000s, everyone believed housing prices could only go one way, up, until they didn't. A few years later, it was electric vehicles, then clean energy, then crypto. Today, it's artificial intelligence. Again, the names change, the cycle does not. That's why I don't think the right question is whether Bitcoin is dead. I think that's the wrong question and the wrong conversation to have. The better question is, what would make investors care again? Would it be lower interest rates, more global liquidity, another wave of institutional adoption, a technological breakthrough, a loss of confidence in traditional fiat currencies? I don't know. And anyone who tells you they know exactly what is going to happen next is probably trying to sell you something that simply doesn't exist. Markets are messy, they're emotional, they're unpredictable, but they're also incredibly cyclical. And that's why I think Bitcoin is in such an interesting position today. On one hand, the excitement is clearly gone. Capital has rotated elsewhere. ETF flows have weakened and are now going in reverse. The AI boom has captured the market's imagination, even strategy. The company that spent years buying Bitcoin almost without hesitation has adjusted its playbook to reflect a changing environment. Those are real challenges, but underneath all of that, the foundation keeps getting stronger. Governments are creating clear regulatory frameworks. Financial infrastructure continues improving. Major institutions haven't disappeared, they're simply becoming more selective. That's a very different story than Bitcoin dying. So, has Bitcoin lost the story? Maybe, at least for now. But stories have a funny way of changing, especially in financial markets. And that's why I think it's dangerous to confuse a lack of excitement with a lack of value. History has punished investors who chase whatever happens to be popular at the moment. And it's also rewarded investors who are willing to stay patient when everyone else lost interest. Now, I'm not saying Bitcoin is guaranteed to make all-time highs. Nothing in investing is guaranteed. Maybe AI continues attracting capital for years to come. Maybe Bitcoin trades sideways for a long time. Maybe this really is completely different. That's always a possibility. But I also know that markets have a habit of making the largest number of people feel wrong at exactly the right time. And that's why I'll continue watching one thing above everything else. Not the headlines, not price predictions, not social media, money. Because money usually tells the truth. And right now, it's telling us a fascinating story. Maybe not the story everyone wants to hear, but certainly one worth listening to. So what am I doing with my own money? Honestly, not very much. My investment thesis hasn't really changed. Inside my lunch money portfolio, I currently own both the iShares Bitcoin Trust IBIT and the Ethereum Trust ticker ETHA. When I first added those positions, crypto made up around 15% of my portfolio. Today, after the recent sell-off, I've actually increased my allocation to around 16%. And if we continue seeing weakness while the long-term fundamentals remain intact, I'm comfortable gradually increasing my exposure to as much as 20%. Now, how has that worked out so far? Honestly, not so good. My crypto positions are currently down around 24%. But that's exactly the point. If I truly believe this is a long-term asset class, then I have to be willing to buy when it feels uncomfortable. Not only when everyone is excited, but when everyone is running. That doesn't mean I'm all in on crypto. It doesn't mean Bitcoin can't fall another 20 or 30% from here. It simply means I'm following the same investment philosophy I've talked about throughout this channel. When my long-term thesis stays the same, but prices become more attractive, I slowly add, not all at once, but over time. Anyways, let me know what you think down in the comments below. Do you think Bitcoin has truly lost its narrative? Or do you think this is simply another chapter in a cycle we've seen before? If you'd enjoyed this breakdown, I'd really appreciate it if you smash that like button and subscribe to my channel. My goal here at Lunch Money Investing is simple. Cut through the hype and focus on the macro forces that actually move markets so that you can make more informed investing decisions or at the very least learn about an interesting topic. Thank you so much for watching. I'll see you in the next one. And as always, protect your lunch money.